Hey guys, my name is Max, and today I want to show you how to value any stock out there. And today we're going to go through a step-by-step guide for absolute beginners, and we'll use real examples such as Google, Tesla, AT&T, Home Depot, and Carnival Cruise Lines. Now, throughout the video, if there's a term that I've used that you aren't familiar with, do look into the description because I did provide definitions for you. Now let's get started. Now there are many ways to value a stock, and company typically falls into these three categories: the present value model, then we have the asset-based model, and the multiple model. All right, looking at the first page, we gotta first determine what category the company actually falls into. Now there's different models of evaluating a stock, so it's crucial to determine which model or a combination of model is appropriate for valuing the stock that you're interested in. Now, the present value model focuses on two things, and that's discounted free cash flow and then dividend value. For discounted free cash flow, the application is typically low to no dividend payout, positive cash flow that is also in line with profitability. And the example we'll use for this is Google. For dividend valuation, the application is dividend-driven stocks such as ETFs, and then also other stocks such as the example that we're gonna use is AT&T, and then I have a bonus example, which is the Home Depot example. And then the stock price typically doesn't change year to year. Now, looking at the asset base, a really simple calculation. People also call it the floor value of the company. And this is typically for companies that are either near bankruptcy, thus also a much riskier purchase to make. But it kind of gives you a general idea also of where the company is in terms of its tangible assets. And the last one is value using multiples, and that would be enterprise value to EBITDA or revenue. And then there's other metrics such as PE ratios and so on. And we'll go through all of those, and we'll use Tesla for this example. Now, moving on to the first sheet, the first thing you should notice is that all of the numbers that were pulled from a finance sheet are in thousands. Now, the other thing is I'm gonna be using colors throughout this video. So blue is gonna be your inputs, yellow is calculated, and purple is future calculated. Now, to get started here, we have parameters, and I also provided you of where to find this information. First is we're gonna start with your inputs that you're gonna grab from Yahoo Finance. So starting over here, you're gonna grab the total revenue, and this is in the company income statement. If you go to Yahoo Finance, you type in your ticker symbol, and you go into the financials right here. Inside the financials, you have these three main tabs: income statement, balance sheet, and cash flow. These are the three main things that you'll be looking at when evaluating any stock. And right here, the top line, you could grab the total revenue for every year that you're interested in. Now, coming down here, you're gonna fill in the rest of this information. You're gonna fill in the net income common stock, the total operating cash flow, and capital expenditure. Now, once you have all that, calculate the free cash flow, which is the operating cash flow minus expenditures. That's exactly what we did here. And I'll do my best to click on each cell to show you the formula that was used. As well, if the formula was simple enough, I put it on the side here of where to find under calculated. You'll see that it's operating cash flow minus expenditure. Now, moving on to the next point, the net income margin percentage. The way that's calculated is income divided by revenue. Moving on to free cash flow divided by net income. What we're trying to do here is project the current cash flow of a company to future cash flow of the company and determine the fair value of the company that way. And that is why we need these metrics here. Once you got these three filled out and calculated, what we're gonna do is we're gonna work on our projection here. Starting with the first year, the way that this is determined is actually the average of the past years. So we took the average and we placed that average to 22 and 23 as well. And then we took the average of the net income margin and we projected that for the future years as well. Now, before we get started calculating the future value, there are a few parameters that we should look at and determine. So the first is the growth of the economy, and that's 2.5%. That's how the rate that the economy basically grows at. Now, for this one here, we're trying to determine the projected growth rate, and you can actually go to Yahoo Finance, go to the analyst tab, and see what the analysts are projecting, and they're projecting 16.5%. And we also put in the shares outstanding. For safety factor, this is your input. And then the last one that we'll need is the weighted average cost of capital. Now, this could be calculated through a formula. However, you can also look up this information on Guru Finance. If you just Google Guru Finance, you can go to their homepage, and then in their homepage, you can type in Google and scroll all the way down to the weighted average cost of capital, and you'll get this number summarized up here, 6.9 as of today. Now that we have all of our parameters, we can focus on our future projections. To find the future revenue of the company, what we're gonna do is we're gonna take trailing 12-month revenue and we're gonna multiply it by 1 plus the analyst growth rate taken to the power of that time period, essentially. To determine net income common stock, we have to take our net margin and multiply it by our total revenue. So that's why these numbers here were determined. Now we're using these numbers to figure out the net income common stock. Then once we have that, we use this number to calculate the free cash flow, where the free cash flow is determined by taking our net income common stock and multiplying it by our free cash flow divided by net income percentage that we got earlier. Now, what we do next is we actually do the exact same thing to all the other years. Next, we're gonna figure out the discount rate for the stock, and that is based on our weighted average cost of capital. And we do this for the other time periods. Once we get here, we're gonna determine the terminal value here. Essentially, terminal value is taking the value of the company at the end of the year that we're interested in. In this case, it's 2023. And it's just taking it to the beginning of 2024. And that is done through this formula here. And how it's calculated is we take the cash flow from 2023 in this case, and we multiply it by 1 plus the perpetual growth rate divided by the required rate of return that we calculated minus the perpetual growth rate. Once we have our terminal value, we have to discount our terminal value. So this number here is just a copy of this number. And once we have the discounted terminal value, which we have down here, we sum up all of these values to get our value of the company today. Once we have the value of the company today, we divide today's value that we just determined by the shares outstanding to get the fair value of the company. And just for comparison, this is the current price of the company, this is the fair value of the company, and then this is the buy price. And the buy price actually just takes into account your margin of safety. And this method can be used for many, many companies out there. You can also do the same on Apple, Facebook, and so on. But we're gonna move on to the next method, which focuses on dividends. Now, similar to before, we have on this side the parameters, and here I also provided where to find those values. First, we're gonna start with our stock that we're interested in. And for this example, we're using AT&T, ticker symbol T. And we go to Yahoo Finance into the historical tab, and we add up all the dividends that we find there. So for example, let's do the Yahoo search again. Historical data, show dividend only, apply. And these are the dividends that the company paid out in the last year. We take that and we add it all together and put it in our sheet. And that's this value here. Now, next is getting the dividend growth rate. Again, for that, I went to Guru Focus and I got my growth rate of 2.1% for this company. And then my required rate of return is 9%. However, you could also use the weighted average cost of capital and then my margin of safety. And finally, the stock value today. So this is just the price of the company today. And the way I do that, just really quick, type in Google Finance. All you need is the ticker symbol and then the price. Now, getting to the fair value, the way that that's calculated, we take the sum of all dividends and multiply it by 1 plus the dividend growth rate from the past 5 years divided by our required rate of return minus the dividend growth rate. And we get our fair value today. Now, when we apply our margin of safety, the buy price is actually lower than the stock value today. And from this, you can tell that it's just not a good time to buy this company. Now, as a bonus, I want to share another method. And this method is for extremely high dividend growth rate companies such as Lowe's or Home Depot. Home Depot is sitting right now at 23%. And 23% is extremely difficult to maintain indefinitely. So it's good to have another way of calculating that kind of dividend company. So if we look here and we pull this down, we have the same thing. We have the new parameters. And the main thing that changed is we have this new parameter here that has half-life. And half-life is basically the point at which we expect the company's growth rate to hit half of its current growth rate. And the other thing that changed is we have now a short-term and a long-term dividend growth rate. Now, for the past 5 years, if we pull this down, Home Depot has been able to put out 23% growth rate on their dividends, which is really impressive. And then this is the growth rate that I think is reasonable for the company in a period of 8 years time. Additionally, there's also a required rate of return as well as before. So that's 10% for this stock. And then one thing to notice is on top of them growing their dividend, their stock is also growing very well as well. So this is where you're actually gonna combine methods and figure out the true value. But just looking at this method here, if we finish the calculation, we find that the fair value of the company today is $360. It's trading at $270, and our buy price with safety factor of 25 is $288. So that means that this company would be a buy just on the dividends alone, not looking at the stock that is appreciating. Now, moving on to the next method, and this method is for highly tangible companies or companies that are close to bankruptcy or have a lot of liabilities on their hand. And for this example, we'll look at Carnival Cruise Lines just because they are sort of in that situation right now. Now, once again, provided the parameters and where to find the information. So let's dive in. Now we take the total assets and we subtract the total liabilities to get the total equity gross minority interest. And this value can actually also just be pulled from Yahoo Finance and you don't have to calculate it. Then we take the minority interest divided by shares issued to get the fair value or the floor value of the company today using this method. We discount it with our margin of safety to get the buy price today. Now diving into our last method of evaluation, and that's through multiples. And this is what I use to look at really high growth companies that also have limited history on them and are extremely difficult to validate. Now, this is not a foolproof method by any means. There's extreme amount of risk with high growth companies and there's a lot of uncertainty. And that is why people see really good returns on them if they pick them wisely. All right, and for this to work here, what we're gonna do is we're gonna go to the Yahoo Finance tab again. We're gonna go to statistics. We're gonna scroll down here, and here you actually get quarterly statistics on the company, and you get all of the statistics and metrics. So all that happened here is I took all of that information and I inputted it here. And just to go through it really quickly, the things that we really wanna focus on is often the trailing P, and then the forward P, or the drastic change between the two. In this case, it's massive. And then the PEG ratio is also something that is commonly used to look at growth companies. The lower the PEG ratio, the better the investment is, just because the growth of the company is so massive. And the reason why it's so difficult to value these growth companies is sometimes you're stuck using last year's earnings to value a company that is growing at such fast rate that the last year's earnings will never actually end up making sense in evaluating the company. So people often look at PEG, forward P, and so on. So the PEG of 1.23, that is really, really good. Price to sales, so that is the price of the stock to the sales that the company is seeing. And then price to book, typically companies that are 1 and below are good, but with tech companies or high growth companies, this will never be the case. Next thing we look at is EV to sales. So enterprise value is a metric that is calculated, but they do provide this for you. And it could be divided by sales, which is the same as revenue actually as well. And then EV to EBITDA is also another metric. Typically 30 multiple is what you'll see for a technology company. And then I also have the current stock price, and I also have the analyst growth rate expected for the 5 years. And the growth rate for Tesla is absolutely insane. And that explains why the PEG ratio is really, really good for this company. Now, what we're gonna do here is we're not done here. We just looked at the metrics for Tesla, but we do need to have some kind of company to compare it to. Frankly, right now, there's no real competitors for Tesla. So we're gonna compare it to some other tech companies out there, which are also trading really high at the moment. Now, looking at this next company, this is Zoom. If you look just at the PE, Tesla looks extremely overvalued. But then if you look at the forward PE, Tesla sees a massive drop. Now, when we look at the PEG ratio, which I said is very important, Zoom's is actually a little bit higher than Tesla, and it's actually gonna add up to a lot of difference. And part of the reason why it's higher than Tesla's is to do with the analyst predicted growth rate for the company. If we look at any of these other metrics, such as price to sales, price to book, enterprise value to revenue, EBITDA, these are all much, much higher than Tesla's. And so far, Tesla is looking like an amazing buy compared to Zoom. And the more companies that we compare this with, the better it is in the end. And right now what we're gonna do is we're actually gonna take a mature company, so a company that doesn't have the same growth rate that these two have, just to see what it would be like if we compared it with a regular tech company. And if we look here, trailing PE and forward PE, so these are the numbers that actually make sense. These are the PE ratios that are typically surrounding the tech stocks. If we look down here, the PEG ratio is still not bad and is actually better than Zoom. And then the price to sales, much, much lower. Price to book, EV to sales, EV to EBITDA is actually really good when you compare it to other companies such as Facebook and Apple. Google is actually lower than those, and that's really nice to see. And then the current stock price of the company, and again, I want to look at the analyst growth rate as well. So let's not stop there. Let's compare another company, NIO, which is actually a direct competitor, Chinese competitor to Tesla, who do have autonomous driving as well. But in my opinion, they're not doing really as well as they should be for the price that they're trading at. Because if you look at these multiples here, again, Tesla wins out really big time. All right, we're gonna do a couple more companies. Snowflake, another really big company that IPO'd this year and has just skyrocketed ever since the IPO. And again, the same story can be told. All of these numbers here, except for price to book value, are much bigger than Tesla's. So far, even to this company, Tesla looks like a really nice purchase. Just to see what it would be like comparing it to a company that doesn't even belong, stacked up against these technology companies, is AT&T here. And as you can see, the numbers are much, much lower, and that's mainly due to the analyst growth rate being negative 1.73%. And as you can see, the PEG ratio is actually really, really poor for them as a result of that. So this is not a company that you want to invest in. Now, aside from Google, out of all of the companies that we went through on this tab using multiples, Tesla is the one that makes the most sense by far to purchase and put any kind of investment in. But before you do that, you should always research your stocks further. Even though you went through all of these metrics and now you know the price that you should be buying the company at, it's extremely important to completely understand the business. Take a look at what happened this year. The pandemic hit and a lot of investors panicked because they didn't know what that would do to the market. And as a result, companies such as Facebook, Google, Amazon, and so on all fell in share price during March when everything else was falling, because nobody understood what that would do to those stocks, when in fact the pandemic actually significantly benefited those companies to where they're trading now much higher than they used to. And it's because the pandemic actually accelerated their growth. So always make sure you understand the company and where their revenue is coming from, so that you can also think about what's gonna happen in the future with the company, as that is probably the most important metric out there. And once you understand that, you can actually figure out whether or not this company is a buy for you and whether or not you should be risking your money investing into that company for higher gains, or you should just be investing in index funds. Thanks so much for watching, leaving a like and subscribing. I'll see you next time.